For several weeks, global metal markets were captivated by a question few investors had ever seriously asked before. What happens when assets long regarded as pillars of stability begin to behave like speculative technology stocks? From early January 2026, trading screens from London to Shanghai told the same story. Prices were moving faster than fundamentals could explain, and volatility was quietly building beneath the surface. Gold, silver, copper, and tin all surged in rapid succession. The scale and speed of the price increases were astonishing. Gold climbed relentlessly, silver accelerated even faster, and base metals followed close behind. Copper briefly broke above $14,500 per metric ton, a level that implied not only strong industrial demand but also expectations of extreme future scarcity. Tin and other industrial metals mirrored the move. Familiar supply and demand dynamics appeared to lose their influence, replaced by the overwhelming force of speculative capital flows, particularly from China. Then, within a very short period of time, the frenzy reversed violently, leaving behind one of the sharpest collapses ever recorded in global commodity markets. On the 30th of January 2026, silver plunged by approximately 26% in a single trading session, the steepest one-day decline in the modern era of systematic price tracking. What had taken weeks of speculative buying to build unraveled in just a matter of hours. Gold, traditionally viewed as the benchmark of stability, was not spared. On the same day, gold prices fell by roughly 9% in one session, marking the worst daily performance in more than a decade. For an asset often described as a store of value, such a move was extraordinary. Copper followed a similar path. After peaking above $14,500 per ton, prices reversed sharply, erasing weeks of gains and trapping traders on the wrong side of leveraged positions. Liquidity thinned rapidly, stop-loss orders cascaded, and margin calls accelerated the decline. What made this episode exceptional was not only the magnitude of the moves, but their synchronization across metals with very different economic roles. Precious metals, industrial inputs, and strategic materials all moved in unison upward, then violently downward, highlighting the dominance of speculative positioning over fundamental differentiation. Senior executives at major refining and trading firms openly acknowledged that they had never witnessed such extreme, correlated volatility in their careers, even during previous crises. January 2026 is now regarded as one of the most chaotic periods for metal markets in decades, a moment when assets once considered safe, slow-moving, and fundamentally grounded transformed into vehicles of rapid speculation. In a world saturated with liquidity and fast-moving capital, even the most stable markets can become unstable when momentum, leverage, and crowd psychology take control. To understand why the metal markets overheated so violently in early 2026, it is necessary to look beyond short-term price action and examine the forces that had been quietly building for years. The first and most structural driver was the steady accumulation of gold by central banks. According to data from the World Gold Council, central banks purchased more than 1,000 metric tons of gold in both 2023 and 2024, the highest two-year total on record. This trend accelerated through 2025 as monetary authorities in Asia and the Middle East sought to diversify reserves away from the US dollar. By early 2026, gold was no longer viewed merely as a hedge against inflation, but as a strategic reserve asset in a fragmenting global financial system. At the same time, confidence in the U.S. macroeconomic outlook was deteriorating. Persistent fiscal deficits, rising interest costs on federal debt, and slowing real growth raised doubts about long-term stability. These concerns were compounded by growing political pressure on the Federal Reserve, with investors increasingly questioning the institution's independence and its ability to balance inflation control against financial stability. Each new data release or policy rumor added fuel to demand for perceived safe havens, even as those havens themselves became crowded trades. Geopolitical risk further amplified this dynamic. Ongoing conflicts in the Middle East, instability in parts of South America, and rising tensions across major trade corridors reinforced the narrative of a more fragile world order. In such an environment, metals, particularly gold and silver, became symbolic insurance against systemic disruption. Yet, the decisive accelerant came from China. Large-scale speculative flows, originating from both retail investors and institutional players, surged into metals markets in late 2025 and early 2026. Capital that had previously rotated through property, equities, and cryptocurrencies found a new outlet in commodities, pushing prices rapidly higher. Signals from the People's Bank of China, including accommodative liquidity conditions, indirectly supported this wave of speculation. As prices climbed, leverage multiplied the effect. Trend-following funds, futures traders, and options markets expanded aggressively, with open interest and derivatives volume reaching record levels. Gold and silver, once defined by their role as defensive assets, increasingly behaved like high-beta instruments. By January 2026, the metal markets were no longer driven primarily by hedging or long-term allocation decisions, but by momentum, leverage, and short-term positioning conditions that made the subsequent collapse not just possible, but inevitable. The turning point of the metal frenzy arrived not with a data release or a supply shock, but with a political signal that markets interpreted as validation of their most aggressive assumptions. On May 27, a public statement by Donald Trump in which he acknowledged pressure on the US dollar while insisting it remained very strong was read by traders as a green light rather than a warning. Within hours, metals markets reacted forcefully. Gold surged toward $5,600 per ounce, silver broke above $120 per ounce, and speculative momentum accelerated across futures and options markets. The move was less about the literal content of the statement and more about what it symbolized: political normalization of dollar stress at the highest level. This surge, however, pushed prices into an increasingly fragile zone. Valuations were now discounting extreme scenarios, persistent currency debasement, policy paralysis, and prolonged geopolitical instability, while positioning had become heavily one-sided. When U.S. markets opened later that same trading cycle, the dynamic shifted abruptly. The U.S. dollar strengthened sharply, reversing days of weakness, as capital rotated back into dollar-denominated assets. This move alone was enough to stall the metal rally, but it was only the first domino. Shortly afterward, market chatter began circulating about a potential nomination of a hawkish figure to lead the Federal Reserve, reigniting expectations of tighter monetary discipline. Even without official confirmation, the implication was clear: higher real rates, less tolerance for inflation, and a stronger policy backstop for the dollar. Gold, which had already begun to slip, fell more than $200 per ounce in roughly 10 minutes at one point, triggering automated sell programs and margin calls across leveraged positions. What had been a controlled pullback rapidly morphed into disorder. The decisive blow came from Asia. Unlike previous sessions, when Chinese investors had consistently added fuel to rallies, this time they moved in the opposite direction. Large-scale profit-taking emerged almost simultaneously across Shanghai-linked contracts and offshore markets. As one international trader put it bluntly, China sold, and the rest of the world paid the price. Given the concentration of speculative positioning, the selling pressure overwhelmed liquidity. A routine technical correction cascaded into forced liquidations, transforming a pullback into a historic collapse. The consequences rippled outward with speed. European and U.S. markets, which had absorbed much of the earlier upside, now faced the downside without the stabilizing bid from Asia. Correlations across assets spiked, volatility surged, and risk models failed to adjust quickly enough. By the end of the session, the metal complex had suffered one of the sharpest synchronized declines on record, erasing weeks, sometimes months of gains in a single day. This episode underscored a critical reality of modern markets. When prices are driven by leverage, narrative, and cross-border capital flows, reversals do not unwind gradually. They snap. The collapse was not the result of a single cause, but of a tightly wound system suddenly pulled in the opposite direction. Once momentum reversed and China stepped aside, gravity took over, and the global market felt the impact all at once. The violent metal market episode of early 2026 leaves behind a clear and uncomfortable lesson. Even assets traditionally viewed as ultimate safe havens are not immune to extreme instability. Gold, long regarded as a store of value during crises, experienced intraday swings exceeding $200 per ounce and a single-day decline of nearly 9%, a magnitude more commonly associated with high-risk equities than defensive assets. This alone challenges a core assumption held by many investors that safety is inherent to the asset itself, rather than dependent on market structure and behavior. What the episode revealed most starkly was the power of crowd psychology amplified by speculative capital. Once gold and silver became symbols of distrust in fiat currencies and geopolitical order, they ceased to function as hedges and instead became momentum trades. The line between protection and speculation blurred rapidly. By the end of January 2026, price movements were driven less by inflation expectations or central bank demand, and more by leveraged positioning, trend-following algorithms, and short-term narratives. When sentiment flipped, the same forces that propelled prices upward accelerated their collapse. This dynamic was further intensified by the modern financial system's high degree of interconnectedness. Capital moved across regions and asset classes with extraordinary speed, a shift in expectations in U.S. monetary policy, combined with profit-taking in Asia, transmitted stress globally within hours. Liquidity fragmented, correlations spiked, and diversification benefits vanished precisely when they were needed most. Events that might once have remained localized instead cascaded through futures, options, currencies, and equities simultaneously. The broader implication is sobering. In today's markets, stability is conditional, not guaranteed by asset class or historical reputation. When leverage, narrative, and synchronized behavior dominate, even gold can behave like a speculative instrument. The metal frenzy of 2026 serves as a reminder that risk does not disappear. It merely changes form, often when investors are least prepared to recognize it. As the turbulence in global commodity markets exposed the risks of speculative excess, China was simultaneously confronting a very different, but equally structural challenge: the looming wave of end-of-life electric vehicle batteries. After more than a decade of explosive growth in electric vehicle adoption, China now faces a rapidly rising volume of spent power batteries. Industry estimates indicate that by 2030, annual end-of-life EV battery waste in China could reach around 1 million metric tons, a scale large enough to pose serious environmental safety and resource security risks if left unmanaged. The dangers are multifaceted. Improper dismantling of high-voltage batteries significantly increases the risk of fires and explosions, particularly when handled manually by unregulated workshops. At the same time, discarded batteries contain toxic chemicals that can contaminate soil and groundwater if mishandled. Even more critically, uncontrolled recycling leads to the loss of strategic metals such as lithium, nickel, cobalt, and manganese materials that are essential to battery manufacturing and increasingly contested in global supply chains. For a country that still depends heavily on imports of several of these raw materials, such leakage represents not just an environmental issue, but a strategic vulnerability. In response, Beijing moved decisively. A new regulatory framework on the management, recycling, and comprehensive utilization of power batteries officially came into effect on the 1st of April 2026. One of its most consequential provisions is simple but far-reaching. EV batteries may no longer be removed from vehicles when those vehicles are scrapped. Instead, batteries must be collected together with the vehicle and transferred directly into a state-supervised, formal recycling system. This measure alone eliminates a major channel through which batteries previously flowed into informal and often dangerous recycling networks. To enforce this shift, the Ministry of Industry and Information Technology, MIIT, is building a national digital platform to track the entire life cycle of every EV battery sold in China. From manufacturing and sales to repair, replacement, dismantling, recycling, and secondary use, each stage must be reported. Every battery pack is assigned a national identification code, often described as an electronic ID card, allowing regulators to trace its location and status in real time. This system sharply raises transparency while making diversion into black market channels far more difficult. The new rules also expand responsibility across the industry. Recycling is no longer confined to specialized waste processors. Battery manufacturers, EV automakers, importers, and related enterprises are now legally obligated to participate in battery recovery. They must establish or cooperate with certified recycling networks, publish contact points for battery returns, and ensure that all collected batteries are transferred to licensed facilities. Secondary use, such as repurposing EV batteries for stationary energy storage, is permitted only for organizations that have received formal approval and meet strict technical standards. The scale of the economic stakes is substantial. By 2025, China's battery recycling market was already valued at approximately 558 billion yuan, about $78 billion, according to industry reports. Leading recyclers have demonstrated recovery rates of over 96% for lithium and nearly 99.6% for other critical metals, showing that the technology is no longer the bottleneck. The challenge lies in channeling batteries into the system consistently and safely. Taken together, these measures signal a clear policy shift. China is treating EV batteries not as disposable components, but as strategic assets whose value extends beyond their first life cycle. By tightening control from cradle to grave, Beijing aims to reduce safety risks, protect the environment, secure critical materials, and reinforce its long-term dominance in the global electric vehicle and battery ecosystem. At a broader level, the policy signals a clear transition in governance philosophy. China is moving away from rapid, loosely regulated expansion toward long-term, controlled, and sustainable management. Growth is no longer judged solely by volume, but by resilience, recoverability, and strategic depth. How do you see this shift? Is China setting a global template for the future of battery recycling, or will other regions chart a different path? Thank you for watching the video. If you have a different perspective, please share it in the comments.